on year-end tax strategies, prepping for 2024. My name is Zach Holcomb, and I work with Tim here at Dyer Wealth Management, and I'm helping him moderate tonight's session. Tim's going to be running point on this in just a minute. However, there are a few housekeeping items I'm going to cover with everybody before we get started. Briefly, just to jump right in, if you don't know who Tim Dyer is, he's the owner of Dyer Wealth Management. Tim has spent the last 25 plus years helping families get into and through retirement with high quality financial, investment, and tax expertise. He's been featured in numerous financial publications, some of which you can see on the screen right here. But my favorite thing about Tim is his ability just to simplify something that can be extremely complex using a really, really easy to understand approach, which you're going to see on full display tonight. Now, logistics for tonight's session. First of all, we really appreciate you taking time out of your busy schedule to join us here this evening, and we want to be respectful of your time. So anticipate tonight's discussion lasting about an hour, maybe a few minutes more. Now, if you have any questions about anything Tim is covering throughout tonight, drop those questions in the chat using the chat feature in Zoom. Now, keep in mind, this is a private chat, so only Tim and the moderator can see this. Nobody else is going to see those questions that you drop into the chat. Now, the last thing I need to cover, and this is the fun stuff, if you can go back to that disclosure. This is the exciting stuff, right? Now, essentially what this is saying is tonight is going to be about information and not specific advice. For Tim and his team to give you specific advice, he would need to have a full, complete black and white understanding of your financial situation. Now, anything that we discuss tonight, if you want to deeper dive into that, you're going to have the opportunity to meet with Tim and his team one-on-one before the end of the year to potentially help you with some of these strategies that we're going to discuss. And we're going to share more information about how you can do that as tonight's sessions go on. But we're going to make it as easy as possible for you to get on Tim's calendar if you'd like to do so. I'm getting the signal from Tim that he's ready to go. You ready to get rolling?
Yeah. Well, thanks for the introduction there, Zach. That was more formal than I anticipated here, right? So we're gonna jump right in. As you said, there's I know everybody's time is valuable, and I wanted to just kind of start off. We look at this quote, this old adage, and I think it still rings true, right? It's not how much you make, it's how much you keep. Now, it says Robert Kiyosaki, but I think you could attach anybody's name to this comment because everybody has said it. But as we go through tonight, we're going to look at some things. Some of them are easy to implement, almost checklist items. Some of them have time frames attached to them, like the end of the year. And some of them are a little bit more far-reaching, like tax planning out 2, 3, 5 years or beyond. But I also wanted to start off by just saying, hey, look, let's not forget the big picture. We're going to look at ways to reduce taxes, okay, this year and in the future. But why are we doing this, right? One of the main reasons why we're reducing taxes is so that we can spend more time with our family. We can travel. We can, go out to dinner, golf, whatever it is that is important to you. That's the real result. And tax planning is one way to help maybe do that faster, more efficiently. But a good financial plan is really going to be the basis, whether or not you can save money in taxes, that you can implement and live that, dream life now and potentially in retirement. So let's kind of jump in here. Let's see if I can click through here. All right. When it comes to planning and all of these things, there's really two approaches to this. The first one is a proactive approach. Now, just being here tonight, it's 6:30 on the West Coast. It's 9:30 on the East Coast. And I know we've got some people on with us tonight from both coasts and everywhere in the middle. But that's a step in the right direction. You're actually taking ownership of the fact that you are the one that controls this. There isn't somebody that the IRS isn't going to send you a letter and say, here's what you should do, right? You need to be your own advocate, okay? Just move my little speaker here. Now, far too many people are just reactive when it comes to this. And I think one of the keys to success is instead of just looking at things year by year, okay, when you file your tax returns, you want to have an approach that looks at, okay, what are the impacts of things in this year? But what are some things that maybe we could spread out, delay, or accelerate, maybe because there's an opportunity through paying lower taxes? All right. there's a difference between tax preparation and tax planning. And we have this conversation a lot here at the company. Tax preparation, quite simply, is it's the ability. It's kind of like keeping score, right? A lot of our tax preparers, CPAs, they're really good at collecting the information that you have for the year, getting it assembled and put together so that it can get filed appropriately in the right time frame off to the IRS. But when you think about it, I want you to think about it for a moment. It's April 2024. You're looking over all of your tax information. Your CPA is looking over all your tax information. He or she's probably got a stack on his desk that's as high as the ceiling. And he's trying to get those returns from the right side of his desk to the left side of his desk, the completed side, right? And I think far too often people assume that, all of that tax prep is what they think is tax planning. They're two separate things. And so we need to kind of expand just more from the tax prep and think about how can we be doing more proactive planning on an ongoing basis. I think this slide kind of sums it up, maybe a little blurred, but this is how I define tax planning. There's the taxes that you pay, and there's the taxes that you could have paid, right? The difference in that is that lack of planning, all right? So we're going to do some of that tonight and see if there's some ways that we can get some quick wins for you and getting you thinking differently about the different opportunities that are out there. Now, I think we got to first start off with the current landscape, all right? This particular slide, this red line, if you will, is showing us the highest marginal tax rate in the United States. It goes all the way back to the early 1900s, okay? This is when we think about the different tax rates. This is the highest rate for each given year. Now, we're all the way to the right, all right? And that number down here, I don't know if you can see the mouse, but we're at the highest rate now is 37%. That's going to go up here a little bit in a few years. But when you look at this, if we just kind of zoom out for a second and think, okay, historically, are we closer to the high part or are we closer to the low part? And I would argue that 37 is pretty close to historic lows, about as low as we've been, okay, especially in the modern era. Now, I remember reading a story about this particular time era. Ronald Reagan was working as an actor, and his income was over $1 million at the time. Actually, maybe it was $100,000, excuse me, adjusted for inflation. But he would only work on 2 movies a year, and that was because so much of his money was in that highest tax bracket. It almost cost him money to do another movie. Now, we would all know that he would be instrumental in those tax cuts in the 80s and kind of start this movement to where we are now. But either way, if we take nothing away from this, it's just historically, we're at the lower end of where tax rates are. Now, if you haven't seen this slide before, it's pretty chaotic. And maybe we can put this in the chat if you have access, or we'll send it. But it's right there at the top, usdebtclock.org. Now, I'm going to zoom in on something here. Right, and I'll just go back. This is the top left. This is our national debt. That number is 33, not million, not billion, 33 trillion. Okay. Now, this slide, when I copied and pasted in before, it was 23 trillion. And I look back just to kind of get an idea of when that number actually was 23 trillion. And I think it was 2020, right before COVID. It took almost 200 years of this great nation to get to 9 trillion. And then we went from 9 trillion to 20 to 30 in the span of about 20 years. So this is some headwinds, all right? Now, we looked at rates, where they've been. We're looking at some of the things that are going to affect tax rates in the future. This is a big one. One other thing I'll just add on this debt clock is in this middle section. Let's see, right under here, you'll see what is spent on Medicare, Social Security, and defense. It makes up, it's kind of small in this picture, but it's the budget items. This is what you need to know. Almost 80% of our budget is just covering those three things, Medicare, Social Security, and budget. Now, it's not all bad. This is an easy problem to solve. It's simple. We either just cut spending, right? We take our revenue from taxes and we cut our government spending. We create a surplus and we start, meeting our obligations and cutting down the debt. That's all we need to do, right? I hope you picked up on my sarcasm there a little bit, because that is not something that our government and Congress has reliably been able to do. And the other option is to raise taxes. In fact, on this graphic, there is no road that takes us to cut spending. Everything that we've seen just shows that we've got more spending, which leads to the higher probability, and I would say almost certainty, of higher taxes in the future. All right. So what planning considerations and strategies can we look at around that? Now, busy slide here, but bear with me. What we're looking at is, this is the Tax Cut and Jobs Act of 2017. All right. TCJA, most people commonly refer to it as the Trump tax cuts. All right. Putting politics aside here, we just want to take a look right now where that first line where ordinary income tax rates are. And those rates, they range from 10% all the way up to 37% on the tax rates, okay? We're going to dig into this a little bit more detail, but high level. Then when we look at capital gains rates, and we'll look at what is affected by that, those fall into three brackets: 0, 15, and 20%, okay? Now, the government allows us something called the standard deduction, and those numbers have actually been increased right now under the tax cuts. If you're single, you get $13,850 off the top. And if you're a married couple, it's $27,700. It's a little more with an age consideration. Now, some things that actually, I guess we could say, got worse with the tax cuts were the SALT deduction. And I'm not talking about your MSG intake or whatever at the dining room table. We're talking about state and local tax. They the Trump tax cuts put a cap on that at $10,000. Okay, before it was a significantly higher amount, which created a larger deduction. Remember, you used to be able to deduct a lot more of the interest on your house. Well, that's now limited to $750,000 of aggregate debt. And then we've got some caps on charitable deductions. And then we've got some different, we're going to cover these levels of spending on the retirement accounts here in a little bit. But this is the framework of where we are now. Now, the thing that's I want to mention too about these tax cuts is, when they went into place, they had an 8-year life cycle. It's kind of interesting how that worked, right? President thought, 8 years, and then they expire, and you got to kick it down the can to the next group. Well, that 8 years is up at the stroke of midnight, December 31st, 2025. And all of these changes that you see on the screen right now, they're going to what's called sunset, which is just fancy jargon for saying they're going to go back to what they were before these tax cuts, okay? So we'll dig into that, but I like to look at this graphic here, and it really kind of helps compartmentalize the different types of income, okay, that you can have. Now, if we think about this first row, you've got ordinary income and capital gains. All right. And I put some of the, key items in each. When you're looking at ordinary income, hey, this is your paycheck from work. If you're a contractor, that's 1099 income. You've got your Social Security income, your income from rental properties, businesses, interest. A lot falls into that ordinary income. And when we look at this first bucket, all right, we're going to go around the horn and talk about each one of these and what the strategies we use based on each of them are. But when we look at this bucket, these are the rates that we're taxed at. Now, we just looked at this in our summary just a second ago, but 2023, the tax rates go from 10 to 37%. And when we talk about how they're going to sunset in a few years, they're going to revert back to what they were before. And I've put that right down here in this 2026 column. Now, you'll notice that, 6 of those numbers I've underlined. Those are all increases, right? So Congress is kind of sneaky in this, because they don't say, hey, we're going to do a tax increase. What they're doing is they're saying, oh, we've got a sunset, but that sunset is going back to these higher rates. Everybody with me? All right. Now, it's not all bad news. What we're looking, the U.S. tax system is what's called a progressive tax system. So as your income goes up and you go into these different tax rates at the different bracket levels, when you get to a higher level, I find a lot of times people think, well, I moved up a bracket, so now all my income is taxed at 24% or 25%. That's not how it works. Here's an example of a single filer, okay? The first $11,000 is going to be taxed at 10%. From $11,000 to $44,000, that's taxed at 12%. Then you got a bigger jump from $44,000 to $95,000, that's at 22%. So when we think about the difference between $95,000 and $100,000 of income, ordinary income, really there's only $5,000 that's at that 24% rate, not the entire amount. Now, that's a good thing. Let me just revisit here. These are those rates again. Now we just do them from bottom up. So on the one hand, I mean, I'm beating a dead horse here, but the rates in 2026 are higher, but that's only half the story. Here's the other half. Well, I put this arrow here because we're going to look at some scenarios where it might make sense to pay some more tax. And say, well, Tim, I thought we're talking about reducing tax. Well, it might make some sense to pay tax this year or maybe in the next 2 years, because at that same level, now we're at 24%, whereas in a few years, before you even get there, you'll be at 25, moving into 28%, okay? And we'll break that down in more detail. But so we talked about how the tax rates are going to change, and I told you that's only half of it. The second half is right here in the middle where these numbers meet. 2023 is the pyramid on the left. 2026 and beyond is the pyramid on the right. But notice those numbers, okay, not the tax rates, but those numbers in the middle. Those are the brackets or the thresholds. So you think of them as buckets. Right now, your first 22,000, and this is married filing jointly. That's what we mean by MFJ. Married filing jointly, the first $22,000 of income you have is taxed at 10%. The next amount up to 89,000 is 12%. The last one we were looking at was single, but I just wanted to clarify why those numbers aren't exactly the same. But let's look now in 2026. Okay, 18,650 is at 10%. Now you're already into the 15%. That 15% bracket is higher than the 12% bracket, and you're already in it sooner. If we push up a little bit, how about if you're making, say $200,000? Well, now you're in the 22% bracket. You're just piercing out of the 22% bracket into 24. But in the coming years, you'll be well into 28. Okay. So there's again, I know I'm hammering the point here. The tax rates are going up and the bracket thresholds. Okay. There's the thresholds. Those are going up. Those are going down. And what does that mean? It means we accelerate through these faster. All right. That's why the conversation now isn't as much about delay, which there's some cases we still want to do that. But sometimes we might want to be bringing some income into now and take advantage of these lower rates that are known. All right. I put the single pyramid here as well. If you want to copy the slide deck, we'll send it to you. So I just got married and then single. Now, next thing I want to talk about here is the standard deduction. Isn't the government nice? They say, well, if we don't have a standard deduction, then every single dollar that you make is going to get taxed. So I said, well, if you're single, you could take $13,850 off the top. Married filing jointly, $27,700. That's the standard deduction. Now that number, the standard deduction, went up with these tax cuts. That means we got a bigger standard deduction. In the past, a lot more people would itemize their deductions, right? That's when you'd sort of, oh, I gave this much to charity and I had this much, this and that. You write down all those deductions, you'd add them up, and it would be more than just the standard that you got. So you'd itemize your deductions. Now, over 90% of the tax filers in 2023 for that 2022 tax year, they claim the standard deduction, okay? That's not a bad thing. The bad thing is that's going to change in a couple of years and probably go back down. So we all know about the rates and the brackets, and now the deduction that you get is going to go down. All right, so I want to give you one of my first Tim's famous 5-star tips, as we call them here. Here's a scenario. This is just a simple gifting strategy. If right now you're giving, say, $10,000 a year to charity or to your alumni school, you might say, hey, $10,000 this year, $10,000 next year, $10,000 in 2025. If you do it that way, each of those $10,000 checks, they're not above the standard deduction. So you're not really getting any credit for that charitable donation. Now, again, there's reasons why you're doing that above and beyond, but I find a lot of people are missing some key tax planning opportunities here by not looking at this a different way. So one way that you could take advantage of this is you can take in this example, take those 3 years of donations in 1 year, make a lump sum gift, okay, of $30,000. Now you can take that deduction. Now it's more than the standard deduction, and you get a little tax break with that. Now the way we do that, just to be clear, is using something called a donor advised fund. So we put the money in the donor advised fund, and you still have complete control about the who, the when that you make those distributions. You might want to make it to charity 1 year. The next year, you might want to make it to your alumni. Third year might be another cause. But as long as it's a qualified 501c3 charitable organization, you can do that. But this is just one example of how looking at the same thing differently, allows you to get a little bit of a tax break. All right, so now let's look at the second bucket that we have here, the capital gain bucket. Now, I like this bucket for a couple of reasons. This has to do with investments and real estate, right? The gains on those type of transactions. Now, they're taxed at a different rate. And you can see up here from these columns between 0, 15, and 20%. Right? If anybody's sold some stock that they've owned for more than a year, they know that they've paid capital gains rate and not ordinary income rate. So something to be said about this. Let's take a look at how this capital gains, may or may not play out. And we're going to talk about this in the context of tax loss harvesting. Let's see one here. Now, tax loss harvesting is really just a fancy name for over the course of the year, doing some tax planning and taking advantage of movements in investments or even potentially real estate, but usually in investment portfolios, when things are down, to use that loss that you've had, whether they're down temporarily or whether they're down long-term from something you've owned a long time, you can use those losses to offset some of that income. Let's walk through an example. Let's take, for instance, you own a stock. We'll just make it easy. You own one stock and you have $100,000 in it. And we all remember COVID just a couple of years ago. The stock market dropped 30% in a month. Okay, it was 6 weeks, but we saw that 30% decline. So that $100,000 stock is now worth $70,000. Now, if you don't do anything there, that's just a decline in value. There's been no action, so there's no taxable implication of that. However, I just put that little line there to designate if you take action and you're to sell that position, you'd have a $30,000 loss. Now, with that $30,000 loss, there's a couple of things that you can do. Well, the first thing that you can do is use it to offset gains, other gains that you have to create a netting effect. But you can use, and this is an IRS limit, $3,000 off your ordinary income. Okay. That has nothing to do with the 30,000. That is just the max. They let you take 3,000 off your income. Now you say, all right, well, I took a $30,000 loss. I took 3,000 off my income. What happens to the rest? Well, you're allowed to carry that forward and use that for future either income in $3,000 increments, or you can use it to offset gains in the future. Now, I put a little note at the bottom. You got to be sure to avoid the wash rule. And the wash rule says you can't buy the same security. I was going to say statistically the same, but significantly similar is what the IRS wording is. But let's go back to this example for a second. Let's just say we got $100,000 in our old friend Warren, but well, I don't want to say old, but with Charlie Munger here lately, but our friend Warren Buffett, his favorite stock is Coca-Cola. Let's say we've got $100,000 in Coca-Cola, and this scenario happens. COVID hits, it drops 30%, it's declined in value, we sell it. But we say, hey, look, this, part of my long-term strategy is to be invested through these dips and hold, and ride out these cycles for higher returns in the future. And I would say, okay, that's a sound strategy. So what we might want to do is keep that same exposure to stocks. But what if when we sold that Coke and took the loss, we took the money and we went and bought Pepsi, just using an example? I think you could argue that you could look at those stocks, they probably move pretty similar, right? Or you could find something that moves similar. Now you've got all that same stock market exposure, and when you get that recovery, you're in the same position that you were, but now you've got this little escrow account that has this, now paper loss that was only temporary. It's now moved over to create, not an asset, but a benefit on your income side. It's reducing your income and it's offsetting future gains that you might have. This is a very, very powerful technique. And so I'm going to give you here another one of my 5-star tips. I want everybody at some point to, tonight, tomorrow, just pull up your investment accounts. And I want you to just, whether you look at your statement or you look at it online, just take a look at what the realized gain and loss is here, if you have any. Like this area here is the unrealized. But if you've already sold some stock for a gain, maybe you go into the portfolio and look for something that's got a loss. If you've got a loss, maybe you go in, you can see in this particular example, there's quite a bit of gain in Apple stock, no shock there. But maybe you can sell a little of that with the loss that you had from another position and you'll owe no tax. Not a bad strategy. We like that strategy. All right, we'll keep moving on here. Let's see here. Checking the chat here. All right, next thing I want to talk about is retirement savings. This is an area where, people have a lot of opportunity to take advantage of plans and benefits that are offered through their work. And the 401k and IRAs are really the 401k and Roth 401k are the easiest ways to get some of these quick benefits. So let's just take a look at what these limits are. Now we're talking about this top right bucket now. Now this isn't technically income. All right, we're talking about assets and the income, how it's taxed, where it's generated from. Let me give you an example. You've got IRAs, 401ks, 403bs if you work for a hospital, or 457 if you work for the government. These are what we call tax deferred, but in English, that just means it's taxed later. You get to take all the benefit, all the growth. You don't have to pay tax along the way, but you're going to take money out. And when you take it out, it's going to be taxed later. Here are the limits. 2023, if you got a 401k, you can put 22,500 in. If you're over 50, there's a match, or not a match, but there's a accelerated contribution. You can contribute an additional 7,500. That brings you to 30,000. I see a lot of people that miss that opportunity because they've just calculated the max and they don't do the max with the catch-up contribution, okay? Two other plans in there. You've got simple IRA, SEP IRA. These are the limits there. Look, the bottom line is if you've got a plan at work, you want to be looking at least contributing to the match and looking at, are you contributing company match, or are you contributing to the maximum amount as well? All right, take care of those benefits. If you haven't, maybe you adjust your paycheck for the last few weeks. I know, right before Christmas, but these have to be in by December 31st, okay? December 31st. Now, there's one thing at the bottom of the slide I'm just going to mention here, and we're going to come back to it. But the limits right now on what you can put into these, what we call defined contribution plans, is $66,000. Most people, I know we've got some people on from Qualcomm and some other companies here in town and across the country. You know, they've got the ability where you can make after-tax contributions to your 401k. And I said, well, what does that mean, after-tax contribution? It means after you max out that $22,500, you can make additional contributions to that. And it sits in this after-tax bucket. But here's the beauty. The IRS lets you actually roll that out, and they let you roll that out into a Roth IRA. And we're going to talk about that here next, the benefits of doing something like that. If you want to write this down, that's what they're talking about when they talk about a mega backdoor IRA. All right. So looking back here, this was talking about the company retirement. Now we're talking about you, the individual, right, outside of the company. You can set up either a Roth IRA, which isn't tax deferred, it's taxed never, or you can set up a traditional IRA, which you can put money in, it grows tax deferred, and it's taxed later. I'd say, well, geez, Tim, you know, if I had to take my pick, I'll go with Roth. Yeah. And we're going to look at what the eligibility requirements are for Roth. But before we do that real quickly, I want to just go over the contribution eligibility and deductibility for a traditional IRA. So let me start from the top on that. Anybody can contribute to a traditional IRA. You can put $6,500 in. If you're over 50, you can put another $1,000 in for a total of $7,500. All right. Now, if we look down here where these check marks are, if you're single tax filer, and your income is under $73,000, you can actually deduct that contribution. Folks, there's tax savings. Married filing jointly, okay, maybe you're between jobs, you know, maybe one spouse works, whatever it might be. If you're under 116,000, you can deduct those contributions, okay? Now, anything, the numbers above, you can't deduct it. And I said, well, wait a minute, there's a little space in there. There's some phase out numbers in the middle. I just like to keep it simple here. You're either below 73 or above 83, below 116 or above 136. So that's the first line of defense. Now we come over to the Roth. Now, this isn't about deductibility. This is about making a contribution with after-tax dollars. So you get your paycheck and you put money in this account. All right. Put in 6,500, another 1,000 if you're over 50. That looks familiar. But here's the thing. Here's the eligibility requirement to be able to contribute. If you're single and you make under 138, you can put money in a Roth IRA. Same thing for married filing jointly. If you make less than 218,000, you're eligible to make a contribution to a Roth IRA. Anything above where those red X's are, if you're over 153 or 228 married, you can't make a contribution to a Roth IRA. Now, that wouldn't be any fun if we just stopped there. So we got to explore what we call the backdoor option. If you want to get money into a Roth IRA that you set up for yourself, the way you can do it is you can contribute to a traditional IRA, okay, and then simply convert it to a Roth IRA, all right, shortly thereafter, right? We don't like to do it on the same day. We like to, let it season for a minute just to keep the IRS happy, right? But this is, I wouldn't call it a loophole, but I'll call it a backdoor strategy, I guess. So in a way, anybody can really get money into a Roth IRA on their own. They just have to do it contributing through the traditional IRA. Okay, so I do want to talk. I do want to talk here about this last bucket because this Roth IRA part is very important. Okay, let's jump in here. Let's just take a scenario. Let's forget about the contributions now. Let's say you're sitting on a tax deferred account, an IRA. Maybe you've got a bunch of old 401ks that are out there that you left behind, you haven't paid much attention to. But you're going to want to ask yourself, does it make sense leaving it in that account? Okay. We know that an IRA is taxed later. And remember what we said at the top of the program. You're looking into the barrel of the shotgun here as tax rates are going up, brackets are going down, all these things. So do we want to pay tax to get money from this IRA, into this Roth account? We got to pay tax. All right. So there's a couple of things that we want to consider. One, what is the tax? How much do we want to convert? Right. And do we want to pay tax on the seed now, or do we want to pay tax on the harvest later? I'm a visual person, as you can tell, and I like goldfish too, but let's look at it a different way. This first row of buckets represent those tax buckets, right? Tax rates. And let's just say you had an IRA and you hadn't done a Roth conversion. Now, I'm just using an example here, and your income, you filled up the 10% bucket, then you filled up the 12% bucket, and you got a little bit into the 22% bucket based on your tax projections for the year. This is where I'd say, hey, this might make sense where maybe we convert some money from that IRA into a Roth, pay the tax, and we do it to amount that we just max out that 22% bracket. Now, I would even argue there's plenty of cases where the difference between 22 and 24% isn't that much. It's another 2% of tax. And this might not be converting on a lot of money per se. Maybe tens of thousands, maybe 100,000. It's a lot of money, but we can control the percent that we convert. So this is an exercise that you want to be running right now. And we can do this for our clients. And this is something that we can help you with, is say, okay, here's my current proposed tax liability. If we've got some assets in these other accounts, IRAs, 401ks, and we want to convert, what's the tax implications of that? And do we want to pay tax at 22% now or 24% now? Or do we want to pay it on 28 or 33% later? All right. I got to mention this one, the health savings account. This is offered through corporations. It really has to do with if you're in a high deductible health plan, they let you set up this health savings account where you can put money in. It comes out pre-tax. Okay. It's not taxed along the way. And as long as you take it out for medical expenses, it's tax-free. I mean, this really is the holy trifecta of, investments or savings options. Okay. If you end up using this for medical expenses, which it's intended for, you'll never pay tax on that money. So I put down at the bottom 2023 the limits. If you're a solo coverage, it's $3,850. If you've got a family health plan, $7,750. Now, in some cases, some people are funding this and they're using it for medical expenses year by year. And that's ultimately what it was designed for, right? High deductible plan, so that a health plan, so that you don't have high monthly expenses, especially if you're not prone to being sick. If that's you, please let me know the secrets. But when we take this a step further and we look at it from a tax planning angle and say, well, wait a minute, if we don't use this for the day-to-day expenses, medical expenses, what if we let that money just accumulate? You can take it out for any reason at 65. It doesn't have to be medical, completely tax-free. So powerful tool, something to look into if you haven't already. All right, we're coming up here on the last couple ones, gifting. You may or may not know, but the IRS lets you, every person, you can give $17,000 to anybody, as many people as you want. So it's per person per year, right? I say, well, Tim, what's the tax benefit of just, walking out and handing somebody $17,000? Well, on the one hand, if you were to contribute more than that, doesn't mean you can't. If you want to give somebody $30,000, you can, but it's going to reduce your lifetime exemption, right? The estate and gift tax exemption. Now, this is kind of comical because right now, but up until 2025, that exemption's basically $13 million per person. Again, if this is going to be an issue for you, I want you to stay at the end of the show and I'll have a special, we'll set up a special time to talk. But no, in all seriousness, it's a lot of money now. It only affects a handful of families now in the country. But like anything, that's going to change in a couple of years. It's going to go down to 6 million. Now, 6 million is still a lot of money. But you know what? There's a lot of property out there that's worth a couple million, and rental properties and retirement. There's a lot of things. All of a sudden, that number isn't so extreme. And without any planning, you could be looking at 40 or 50% to the IRS for that. Okay. But I want to get back to a bigger thing. One of the options that I've seen be very powerful. Now, whether you're a parent or a grandparent or somebody that is providing for somebody that in the future is going to have an education expense, here's a really powerful tool that can work. Now, kind of like the Roth IRA for retirement, the 529 plan is a college plan where you can put money in. It grows tax deferred if you take it out for higher education, college expenses, or qualified expenses, qualified education expenses, I should say. It's tax free. So let's take a look at this example here. Remember we talked about you can give anybody $17,000. Now, if you're a couple, you can give son number one, dad can give $17,000, mom can give $17,000. That's $34,000 for kid number one. You can do the same for kid number two. There's a lot of different combinations, but let's just take $17,000 one person and you use it to fund a college account, okay? Now, if you get a 7% rate of return, this is what we're doing, a future value calculation. 10 years, starting with zero, 7% a year growth, 17,000. Anybody want to put in the chat what they think it is without cheating? It's $250,000. Now think about that. I put in red what the average private university, the average now, if you're going to Yale, it's going to be a little bit more. But the average college expense, $50,000, $17,000 a year as a gift to a child or grandchild over 5-10 years is pretty impactful, right? Now you might say, well, what if my kid gets a scholarship, academic or athletic? All right, and we put all this money in this college account and we don't need to use it. Well, under new regulations, you're allowed to convert that money to that beautiful Roth IRA, which we all know is not taxed later, it's taxed never. So that money can grow. You can put it into a Roth IRA for the student or whatnot. Now imagine this for a second. You go to college, you're about 18. In my case, I think I was 22. No, just kidding. You're 18, 20 years old. And let's say that you got a scholarship and you just let that money roll and you convert it to a Roth IRA and you just held it until retirement. Any idea what that would be worth? Even with no more contributions. That's $6 million. But it's not just that. It's $6 million, 100% tax-free. So gifting is a powerful tool. It can be used to reduce the estate if needed, and it can also lay the groundwork using some of these other tools, and this is just one of them, to have a lasting impact. All right, as we bring it home, for those of you out there that are taking your required minimum distributions, okay, when you turn 70 and a half, you got to start pulling money out of that tax later account, if you will. The IRS is coming for that money. Now, they have moved the age back to 73, and it's going to move back a little bit more to 75. And you would think that, hey, that's a good thing. They're letting me let that money season in this tax deferred account longer. But what do we know? Tax rates go up. They might even go up even more and even more before you're 75. And now you've got a bigger account that's getting hit with bigger taxes. But the point I want to make here is if you're taking these required minimum distributions and you're making charitable contributions to something, why not make them out of your IRA? And you do that using something called a qualified charitable distribution. QCD is what we call it. But you can make a QCD. You can make that contribution directly to a charity from your IRA. You don't have to pay any tax on that because it's going to charity. And you've satisfied, assuming it's enough, that required minimum distribution for the year. Now, if you did it the opposite way, you took your RMD and then you took the money and you gave it to charity, it would come out, you'd pay tax, and then you give less money or you dip into other savings to make that contribution. This is a often overlooked tool. Maximum is $100,000 per year, but that's the QCD. Okay. Now, we've kind of gone through a lot of the basics that are there, and I'm putting up some of what I call advanced strategies. All right. I think each one of these could be a 1 or 2 hour segment where we talk about just these. But, if you've sold a house this year, highly appreciated house, you've sold a large chunk of stock or bonus, if you've got an inheritance, any of these types of sort of large windfalls, won the lottery, anything like that, then these are some strategies that you can use where you can actually reduce some of that W-2 income or 1099 income, okay? And some of them are a little more in depth. Some of them are pretty straightforward, but I want to put this here as some things. And again, when you get the slides, you can look up some of those things or you can ask for our help to see if they apply to you. So, I'd just like to kind of review what we went over tonight. Here are some of the different techniques and strategies that we were looking at. But the key point is, you don't have to do this stuff alone. Now, I know a lot of people on this call brushing up on some of the things that we've talked about, in our client meetings or other types of meetings. There's new people that some of these concepts are completely new. I will just say, if any of these, you have any question about these, we're making ourselves available to go over them. Again, there's a few things that are kind of timely between now and the end of the year. And there are some things that, are impactful now, but they apply to a longer time frame. And I just want to, let me just shift here. One of the things that we're offering tonight for people that are on the call is we've got the ability to provide what we call a tax report summary. Now, with our clients, it's really simple. With a copy of their return, we can create the summary. And what it's really doing is helping us identify, where we are in the tax brackets, where we are, with tax loss carry forwards. We can use that to project what the taxes are going to be for you in the future. And does it make sense to make a decision, to maybe implement a tax transaction now or defer it later? So I don't want to get, too into the weeds with this, but this is a very, very powerful tool that we use with our clients. And this is something that we're able to run for you pretty easily, in a timely basis here, because I know we're coming up on the year end. So how do we do that? The way we do that, hey, look at that. There's my schedule. Cass is here with me. She's cleared the schedule here for the next couple of weeks. If you want to get some time on the calendar, we can do that. There's a link at the bottom, which we'll send out as well to our Zoom. If you're a QR code kind of person, you can take a picture of the code. But anyways, I just wanted to thank everybody for being on. I hope this was helpful and started to spark some ideas because the tax planning really is irrelevant without action. So that's it. Is anything that you need to add, Zach, from a operational standpoint here as we wrap it up?
Nope. Great job. Awesome presentation. The link that Tim has shared here, yes, you can access it via this URL, the QR code, but it's also hit all of your inboxes right now as well. So if you want to access this link post the meeting, it'll be there as well. And then we'll send out the replay here in the next few days. So if you need to go back and reference something, you'll have access to that as well.
Got it. Yeah. So there's a couple questions on the chat. I was just taking a quick look. If they're high level, we can do it if it's something specific about a person's specific situation. I can answer that in person just because of everybody and thing. But again, so for those that are on, thank you for joining. And I'll respond to any of the questions. Or if you want to hop in the Q&A here for a minute, I'll stick around for a minute. Okay. Martin from Maine, tax rates are sunsetting, but so are the mortgage and state tax deductions, correct? Yes, that's correct. So that's a good point. That SALT, as we call it, state and local tax deduction, right now it's capped at 10,000. That's going to sunset back. So it'll be a higher amount. Whether or not it'll be uncapped is still to be determined. Same thing with the mortgage deduction. And I think that will be a positive benefit, especially since how expensive homes are, and people are going to have to start buying homes with higher interest rates potentially, and higher interest rates on higher value properties. So that mortgage deduction could be pretty powerful, especially if it's uncapped. Let me see. I'm going to jump into another one here. I think Cass is queuing them up for me here. Okay, Ramas, is the $6 million estate tax exemption figure for 2026 already decided, or is it still be debated? So here's the thing about sunset, right? Anything can change. We can go to legislation and they can change anything. But with the election coming up next year, we're going to see, very little activity. Nobody's going to want to kind of put their hat in the ring on that. They'll just let it happen and say, well, that's the nature of somebody before me, if you will. But yes, it is designed. It's going to go to 6 million when it sunsets. I remember when I first learned about this out of college, I think it was 600,000, right? That was the total. So it's a much larger number now, but that's a hot topic that's going to be debated, certainly. Ian, my good friend in Florida. Ian, how are you, buddy? Isn't it better to gift big earned? What do we got here? Isn't it better to gift big earned stocks the profit, so you're not taxed on it and win for deductions? Yeah, there is a strategy where you can take highly appreciated stock and you can gift that. Okay, now you're giving it away, right? But you don't have to pay taxes on the gain. So in essence, if you were giving, I'll just use a number. Let's say you're giving away $100,000 of stock, because you don't have to pay tax. If you pay tax on it, you might have $70,000 left, right? And so the charity gets $70,000. You could make that same $70,000 contribution because you don't have to pay taxes on that $100,000. Let me say that another way. I was saying you could do, more with less, but your point is valid in that if you gift stock to a charitable organization, you don't have to pay taxes on the gain. And if you're looking to diversify, yes, it might make sense to do that than to pay out of cash. So hope that was helpful there. It's later there than it is here. So there. Okay, guys, thanks. Jock and Jane out in Portsmouth, Stratham area, New Hampshire. Jane, hope your hip is healing well and you're recovering. Very good. Folks, that's going to be it. Enjoy your night. Happy holidays and happy planning.